A lot of the terms that are outlined in the commitment that we spoke about today are pretty solid, just because they protect the bank and their loan, and specifically how much profit they're going to make.
As a mortgage broker, we can provide a few different options from multiple different lenders. We can take a look at the pros and cons, which ones are going to work best for that situation, and then make a decision moving forward that way. So, just having the variety is a huge strength of working with a broker.
What is up, YouTube? Matt McKeever here, and in today's video, we're talking everything commitment letter when it comes to your mortgages. We've got our mortgage experts back on the show, Josh and Ehren. Really excited to be breaking down commitment letters for you guys, so let's jump into it. What is up, YouTube? Matt McKeever here, and we've got the Findlay team back, Josh and Ehren. Hey guys, how's it going?
Hey, good, how are you?
So I'm excited for today's video. We're going to be talking everything commitment letter, and so I think this is important because a lot of investors throw around terms sometimes without really understanding what these terms mean, or necessarily without understanding all the implications. So before we jump into some of the more nuanced pieces of commitment letters that the audience needs to know, what is a commitment letter?
The commitment letter is basically the most important document that you're going to receive in the commitment. It is the final all-say, all-powerful. If something were to go wrong, or there's a confusion in terms or rates or anything, the lender is going to convert back to the commitment letter. So it is the final document. It's going to give you an outline of your mortgage details, so the amount being registered, your rate, whether it's variable, fixed, closed, open, and any of the perks that are associated with your mortgage as well too. Plus all the fine little details that'll probably put you to sleep while you read, but are really important to you and to your lawyer. So again, pay attention to those.
And then during the financing my real estate journey, when does the commitment letter come?
Be the first thing that you're going to receive after you get the approval. So once we submit your application to the lender and we get the approval, we'll have just a generic email, and then they'll send us the full template of the commitment back. And then that's basically the start of moving forward and getting your mortgage funded.
Nice. And so when it comes to mortgages, everyone automatically thinks about the interest rates. But what are the other things that we should be looking for in that commitment letter?
Yeah, great question. That's what we're going to go over today. There's a handful of different things that you guys should be concerned about, or at least understand before signing your commitment. Everybody's really concerned with just the interest rate in general and what's it going to cost me. But if you don't pay attention to these specific details, it could cost you a lot more than what maybe a higher interest rate would cost you. So today we're going to go over a handful of different things. The first one being Rate Option Plus. All of those products that you see that are plastered all over the internet and on billboards for the lowest rate possible.
Yeah.
Those are Rate Option Plus or bare bones mortgages. They have reduced prepayment privileges. Sometimes they have bona fide sales. This can really affect your real estate investment journey if you don't understand exactly what that means. So a bona fide sale essentially is you have to have an actual sale of the property to be able to get out of the mortgage. Now, if you're looking to invest and use the equity in the property to scale your portfolio, that can drastically put a damper in your specific strategy. So making sure that you're not in a bona fide sale if you're looking to execute that strategy is going to be super important and going to save you a bunch of money. Now, the difference between the interest rate is really nominal, especially right now in a low interest rate environment. I mean, you're getting sub 1%. You're looking at 1.5, 1.6% for a full option insured mortgage product. So taking a few basis points to get the lowest rate possible in the long term probably isn't going to save you any money if you're looking to expand your portfolio.
Awesome.
Yeah, so the second thing we want to talk about too, which is going to come into what Josh was saying on that Rate Option Plus, is your prepayment privileges. So one of the perks of having a full frills mortgage, if you get some of the perks, prepayment privileges are a really good option to have. Not a lot of people take advantage of them, but if you're looking to make some significant chuck downs on your mortgage and either get out of it quicker, or if you're in a cash flow situation and you're just looking to minimize how much you have remaining, that can be a strong option. So there's two things that we look for in the prepayment privileges. The first one is a lump sum payment. Most lenders allow you to have a 20%. It's going to be somewhere between 15 and 20%. 20% is usually the typical. The lump sum payment is that in 1 year, you are allowed to make minimum payments of $100 up to 20% of your original principal amount in that 1 year. You can pay that down on your payment date without any penalty. That doesn't carry forward. So if you don't use your 20% in the first year, you don't get to carry that over to the next year and then do 40%. So again, a good way to kind of chunk down your mortgage and get it down to zero a lot quicker. The second prepayment privileges is the ability to increase your principal payment by 20% of your current payment amount. And again, that's once per year on the payment date. So again, if you utilize both those options, that changes a 25-year amortization down to 20, 15 years, depending on the amount and how often you take advantage of it. So it can be a really key tool to, again, reduce the amount of mortgage that you have remaining on the property.
Yeah. So third thing is our penalty to break. This is essentially going to be dependent on what type of rate that you choose. So if you're choosing a variable rate over a fixed rate, and depending on either a full frills or a no frill mortgage, you're either going to have a 3-month interest penalty or an interest rate differential. We are going to get into the interest rate differential and the different calculations later on in the video, but depending on, again, your investment strategy, if you choose a 3-month interest penalty with a variable rate mortgage, that could be really advantageous if you're looking to tap into that equity, especially if you're buying under value. Now, the interest rate differential, it can be a little bit more expensive, especially if you want to break your term at least before 50% of the entire term of your mortgage. It can be very expensive. So looking at those options and planning out the term of your mortgage before you sign your documents is going to be super beneficial.
Yeah, and just building upon that, I think a reoccurring theme here when it comes to looking at our mortgage commitment is knowing the exit strategy, right? So like if we know what we're trying to do with the property, this becomes so much easier. And that's where, again, being able to clearly communicate your business model to your mortgage professional is going to make for a much smoother process, because then you guys understand what I'm actually trying to do, right?
Exactly. Yeah.
Yeah, and it's not always about the first transaction. I mean, we like to make sure that your first transaction is done correctly, but the most important part is to figure out how does this transaction affect the next one and the next one and the next one, because the majority of the people we're dealing with right now aren't buying one and they're just going to stay there. If they're going to stay there, take a fixed rate, low frills mortgage product. If you're going to stay there for the rest of your life, take the lowest rate possible and do you. But for people who are looking to build wealth, definitely having that exit strategy is paramount.
Yeah, and I know we've talked about this in some other videos too, but having a strategy and a plan in place before that initial conversation with your mortgage agent, having your goal in mind. If it's a 1-year BRRRR, we can play around with the term and the type of mortgage that you're going to get, whether it's a 1-year fixed or a 5-year variable, and essentially minimize your exit penalty as much as possible to make it as profitable as possible as well. So, just having a plan in place and relaying that, asking the right questions in that initial meeting, very key. Speaking of your variable rates and penalties as well too, one of the things you can do with a variable rate is lock it in. So being aware of what the plan is from the lender side and how they accept lock-ins of variable rates. Typically what we see is the rate that you renew at when you lock in has to be a combination of the amount of time that's passed versus the new amount has to be the same as the original commitment. So if you get into a 5-year variable rate and you want to lock that rate in after your 2nd year, the renewal has to be at least a 3-year term to equivalent a 5-year term total. So the 2 years that have already passed and then the 3 new years that you're renewing for are going to equal that original 5-year term. So just being aware of what your renewal is going to be, how long you're going to have to lock that rate in for. If you get into a 5-year variable and it spikes a little bit and you lock it in, be aware that you're now locking in that rate for the next 4 years. So, where a variable rate really makes its money for the borrowers is being able to ride the dips and the lows. If you lock that in right from the beginning, you may lose out on the savings that you originally were going to have on the variable rate. And that lock-in rate could be even higher than what the fixed rate would have been at that time as well too. So just understanding what the costs are to lock in and what that new term is going to be.
And so otherwise for commitment letters.
Yep. Portability and assumability. Portability and assumability are probably the least known and cared about terms in our commitment, but they're super important, especially if you plan on moving. So portability essentially is that you have your mortgage and you have your house, you pick it up like a blanket and drop it on your other house without incurring a penalty. Now, if your new house is more expensive than the current mortgage you have, they'll do something called a blend and extend. They'll get the rest of the amount of money you need for the purchase of your home, they'll blend the rates together and extend it to the term of your mortgage. So you're not going to incur massive fees on breaking your mortgage. Yeah. A lot of people don't think about this, especially for their owner-occupied units. So really great thing to utilize and have, especially if you want to save, $3,000-$5,000 on having to break and then renew your mortgage again for the next home. Assumability. Essentially what you can do is somebody, if your family member really loves you, or somebody wants to take on your mortgage, they can do that without incurring a penalty. All they would have to do is qualify the same way that you qualified for the entire loan amount, and if they meet the parameters of the lender, then they could assume your mortgage for you.
Kind of retouching back on renewal fees as well too. So there's two ways that you can kind of exit out of your mortgage. One is obviously a refinance. The second is you just ride out your entire term and then renew with that lender. Being aware of the renewal fees is something to be important about. We work with some investors who actually, maybe they can't qualify institutionally and their only option is to get into some sort of private, and they may have to end up renewing into a second year just because of the time frame of the project. Being aware of what those renewal costs are. There are some on the private lender side who have a really favorable renewal fee. Maybe it's only $500 to $1,000. And it's just that flat fee. There are some private lenders out there who renew at the, have a renewal rate, but also charge that lender fee as well too, and maybe even the broker fee as well. So if you're renewing, you're essentially paying all the same fees that you did on that initial acquisition of the property. On the conventional side and the institutional side, again, renewal rates do vary. We've seen some that are as low as $500, and then there are some that are, as high as a couple $1,000s. So depending on what your plan is, and just being aware of what those costs are. And again, mitigating total cost of acquisition and exiting out of that mortgage. And then the next thing we want to talk about too is reinvestment fees. So a reinvestment fee is a fee that can get tacked on top of like your exit penalty and the discharging of your mortgage. Reinvestment fee is basically if you exit your mortgage too early, lenders will essentially just tack on an additional fee. So for example, I think MCAP, if you were to exit out of a 5-year in the first year, it's going to cost you an additional $500 as a reinvestment fee. In the second year, it's a $400 fee. And then in the third year, it's a $300 fee. After the third year, it doesn't cost you anything to exit. Those fees are nominal. It's $500, but when you consider it's $500 to $300 to $50 to $400 to discharge on top, it starts to add up pretty quickly. Plus your exit penalty. Next thing you could be up near that $5,000 to $10,000 depending on what type of exit penalty you're looking at. So just being aware of all the fees.
Additionally, another really cool thing that a lot of lenders offer is paying your property taxes with your mortgage. A lot of people don't think about it, but it's kind of something you just don't have to think about. Put it on autopilot, and the lender will take your monthly property tax payment with your mortgage payment, and they'll deal with it on their own. So you'll never have an issue with forgetting or falling into arrears or anything like that. Something to note is when you do purchase a home and the lender is going to be doing that, they're going to take like a reserve. So when you close, they're going to take a portion of it to be able to catch up for that year. So it might look like you're paying twice, but you're not. But the lender always needs to have that reserve to be able to ensure that those payments are being made on a specific date.
Another cool feature that some mortgages have is a skip a payment feature. So this could be useful for someone who maybe doesn't have guaranteed hours, maybe they're hourly, and we've used a 2-year history. Maybe 1 month, if you're sick or something kind of comes up and happens, you haven't made as much money that month, you have that ability to skip that payment and push it to the back end, which can definitely help in some situations. The last thing you want to do is fall a month behind on your mortgage payments and have that shown on your credit history. So that can be a good feature as well too. So, if you are an hourly employee that doesn't have guaranteed hours, or maybe you're some sort of self-employed employee, ask your mortgage broker if this mortgage has a skip a payment feature. It's not common, but there are lenders out there who have mortgages that have that perk on there as well too. So it can be a nice feature to have, especially going through COVID. We've seen a lot of people have their income affected. Could be a nice feature. It gives you a month's grace period, so it could be something good to have.
Absolutely.
Yeah, I think last but not least was the interest rate differential. So There's actually two ways to take a look at it. It really depends on which lender you take a look or you go with. The first, what they're going to do is, it's kind of a convoluted way in which they find how much money you owe them, but essentially if you had like a 5-year term and you were 2 years into your term, you have 3 years left. What they would do is they would find what your current rate is and then what the rate for the money that they're putting out in the market is. They would find the difference between those two rates and then they multiply that by how many months you have left in your term. Yeah. If that amount is more than the 3-month interest penalty, then they're going to charge you the IRD. Now, there's a second way to take a look at IRD that some lenders use as well. Aaron's going to explain that one.
Yeah, so the other way that they calculate the interest rate differential is based off of the Bank of Canada rate and the discount that they apply to that. This method actually causes your interest rate differential to be a little bit more expensive than using a bank's posted rates, just because the posted rates tend to be a little bit less than what we're looking at when we use a Bank of Canada rate and that discounted mortgage rate that they give you. So again, it's a bit complex to kind of go over, but if you want to make sure and check with your mortgage agent, hey, what am I looking at for my IRD? Is it going to be the posted rate, or are we looking at some sort of Bank of Canada discount rate? The equation is actually going to be laid out for you in the commitment. The bank always discloses that. So at the time when we do our mortgage package, we can definitely go over that with the client, make sure they understand the full cost associated with that penalty, and give them a good estimate of what it could be at the time when they're looking to exit out of their mortgage.
All right, so we've covered a lot here, and if you guys enjoyed this, make sure you smash the like button, hit subscribe. But I think the big question is, are these set in stone? Can I ask to change these terms? Like, how does that work? Is there an ebb and flow here, or is it the bank's way or the highway?
It's a pretty great question. A lot of these are kind of set in stone in regards to which product you choose. So the rate option plus are going to have very specific prepayment privileges, and because you're taking a discount on the rate, they're basically handcuffing you into taking that loan and all the terms that go along with that loan. A lot of these terms aren't very flexible, so it's kind of like you get what you get when you go with that lender or that bank. So being able to, again, it all circles back to having a plan and a strategy and being able to speak to your mortgage agent about that, because if you have a strategy and that bank's terms don't really fit with your strategy, we're going to go to another bank. Right? So a lot of the terms that are outlined in the commitment that we spoke about today are pretty solid, just because they protect the bank and their loan, and specifically how much profit they're going to make when it comes to breaking the mortgage or the term or the rate. All those things equal to longevity and profit, and they're for-profit institutions, so they're projecting their profit over a period of time, and your loan is basically guaranteeing their projected profit over a period of time. So it's going to be very difficult for you to break those or amend those terms.
Yeah, and again, it's just another advantage of working with a broker is we have access to multiple products. So when you go to a big six bank, they have one product. TD has their TD product, RBC has their RBC product, and you don't get that variability. TD's rates and terms, their fixed rates are going to have certain exit penalties and costs, and their variable rates are going to have certain exit penalties and costs. If you don't like those, you got to go somewhere else, right? So as a mortgage broker, we can provide a few different options from multiple different lenders. We can take a look at the pros and cons, which ones are going to work best for that situation, and then make a decision moving forward that way. So, just having the variety is a huge strength of working with a broker.
Yeah, I love it. And we've essentially broken down everything about a mortgage I think you guys could ever want to know, but jump in the comment section if you do have any questions. Both Josh and Aaron are actually really good at responding to comments down there, so jump in there if you guys have any questions. And otherwise, reminder, link to all their socials in the video description down below as well. Again, just really appreciate, guys, you were a wealth of knowledge.
Yeah, thanks for having us.
Yeah, thanks, man.
Thanks again to Josh and Aaron for taking the time to break down for us everything about commitment letters. If you guys have any questions, jump in the comment section. Josh and Aaron are really good about jumping in there and responding as well. If you guys didn't know, they actually go live every single Sunday at 6 p.m. on their YouTube channel. There'll be a link in the video description down below. You guys can jump over and check them out. If you guys enjoyed this video, smash that like button, hit subscribe if you're new to my channel, and let me know in the comments what other videos should we be making, because we're making a video a day in 2021 again. Thanks, guys.